Hey everybody, it's Erik Torenberg, co-founder, partner of Village Global, a network-driven venture firm. And this is Venture Stories, a podcast covering topics relating to tech and business with world-leading experts. Hey everybody, welcome to another episode of Venture Stories by Village Global. I'm here today with a very special guest, Brent Beshore, founder of Adventurs. Brent, welcome to the podcast.
Hey, thanks, Erik, for having me on.
So Brent, as an introduction for some of the people who may not be familiar, one of the things you've identified with is the Forrest Gump of private equity. Why don't you explain a little bit what you mean by that, and more so just why don't you explain sort of, when you look at your career, what sort of threads it together? What's the common thread underneath it?
Well, I'm just kind of slow, and I guess I grew up in Joplin, Missouri, which is I guess close enough to the South to be the Forrest Gump of private equity. Yeah, no, I took a very winding career into private equity. In fact, if you would have asked me 10 years ago what I'd be doing, even almost 5 years ago what I'd be doing, I mean, what we do is we're a family of companies, and we acquire family-owned companies and help them, give them a good long-term home for the business, help them maybe with some talents and some level of expertise that they typically don't have access to. But I mean, fundamentally, we're operators, right? So it's interesting, technically what we do is we buy stakes in private companies, which is private equity, right? But when you think of private equity, you think of the LBO model, the leverage buyout, the sort of KKR model, and we're just like about the inverse of that. So whereas traditional private equity, we kind of joke that it's, buy, strip it, lever it, and flip it, right? Is kind of the what they do. We are buying with no intention of ever selling the business. We are using typically no debt in our transactions, and we like to keep the leadership team in place. And in fact, if we don't like the leadership team, why in the world would we get involved with the business? So in many ways, we're the opposite. In fact, one endowment called us very derogatorily the opposite of private equity, and I took it as a compliment, and they were like, "That's not a compliment." And I was like, "Oh, great." So anyway, it started off being an entrepreneur, and then accidentally bought a business about 10 years ago. Did well with that, and I mean, I don't know, as an entrepreneur, you just do more of what works and less of what doesn't. Yeah. And so for us, we saw this just big opportunity that there was going to be this transition. So we're amongst right now the largest intergenerational transfer of private businesses in the history of the world. Most of the businesses that make considerable amounts of money, kind of above $1 million, $2 million a year of income, they're owned by baby boomers. I mean, the vast majority of them. And the vast majority of those don't have an exit strategy. There's not a son or a daughter, or the leadership team can't buy them out. And so, what happens to these businesses? I think it's actually quite, an existential crisis that's getting ready to happen. And so, we're able to help step in. We try to pay a fair price and treat people really well. Yeah.
Is that what's mostly leading to the transfer, the demographics?
It's almost all demographics right now. I mean, there's always been a market for, at some point you have to sell. Like, no one lives forever. All businesses either, are sold, somehow passed down, or shut down. I mean, those are really the three options. And so, we try to offer a very different product, if you want to think about it that way, in that realm.
Yeah. Does an angel list for private equity or that type of transfer exist, or is it an online marketplace wouldn't work in that way?
Yeah, well, so it's really actually interesting you bring that up. I'm a huge fan of AngelList. In fact, I was one of the first people to back some of the syndicates on there, and I love the model. In fact, when that model came out, I was thinking to myself exactly what you just thought. The issue is, compared to startups, all startups want to be known, right? So there's not this information asymmetry that you find in the private markets. When you're selling a private company, you don't want to be known. It's like a very secretive thing. You don't want to tell your employees until it's final. You don't want it to get out amongst your vendors or your clients for fear that they'll, abandon you. And so it's a very closed process versus the startup environment's a very open process from a capital structure standpoint. The other thing is that startups, what makes it so interesting is that model being able to lead a round, and you want a lot of people to kind of come in and kind of be with you in that round, right? Whereas in private equity, you kind of want to take the biggest bite you possibly can and have it be worthwhile. So you're not going to aggregate the same type of dollars behind it. Now, you could maybe do it, it would be interesting. I mean, the fundless sponsor model probably is the closest to that, which is, let's say you and I decided we want to start a private equity firm today, right? We pick a street name and a river, we combine them. Now we've got a private equity firm, right? We throw up a Squarespace site, and now we're out. We can bid on anything we want, and basically whenever we land a deal, what we want to do is we're basically doing 3 deals at one time. We're going to do a deal with the seller, a deal with the debt provider, and a deal with the equity providers. And so if you look at it from that standpoint, I mean, some sort of marketplace, at least if it was anonymized enough, I think it could work. It would just, it runs into a lot of unusual hurdles that you wouldn't expect coming from the startup world. And I think ultimately, it's a level of complexity that I haven't seen anybody addressing it well. I mean, Axial, which by the way, we've been partners on Axial, for a while. They've kind of tried to do this. And, I think they've done a really good job of aggregating a lot of market demand, but it's just really hard based on the visibility of it to get any traction.
So we're here sitting in our office in Silicon Valley, and I'm curious, sort of to go down a few different paths. One is what Silicon Valley doesn't really get or understand or appreciate about private equity. That's one. 2 is how you view venture as an asset class compared to private equity, and then 3, why you're in private equity and not venture. So whichever one you want to take first.
I was going to say, maybe we could start with the last one first. So I went through a romance with early stage companies. In fact, this is probably
you invested in Zapier
8 or 9 years ago. Yeah. Well, so how I invested in Zapier is interesting. So I've known those guys since college. They're awesome, just awesome human beings, from Columbia, Missouri. And that's where I live. And so myself and another guy were the first guys to bring Startup Weekend to Columbia. And this is back when we were by far the smallest, city in the world to have a Startup Weekend. A friend of mine, Brent, had gone on I think it was a trail ride or something with Mark Nager. And so he came back and he was like, hey, there's this really interesting model. I was like, absolutely. I've heard about it. He's like, well, what do you think? Well, you want to partner up and try to bring it to town? And I was like, sure. And then we asked them and they were like, no, absolutely not. And so he had to petition, I think, Mark directly to get us to be able to host it. And it's actually turned into one of the best startup weekends in the world. So 2 Y Combinator companies, Zapier and Equipment Share.
Wow.
Both have come out of there. It's been incredibly value creative. So I had this romance with early stage. I think it's like anything else. You reach a point where you know enough and you knew enough of the people that I knew I was going to be the best in the world at that. I just knew that there was people in far better positioned geography that had far better, stronger networks. I love Missouri. I love being in the Midwest. I don't want to live in Silicon Valley. No offense to you guys. I think it's awesome. I love visiting. I also love visiting New York, and I also love visiting Chicago and Dallas. And so, I knew being from Missouri, it was not going to be a hotbed of, certainly there are firms that have popped up since, but, in terms of being the best in the world, we're going to be able to do it. So, what I love about venture is, you're basically enabling creativity, right? Which in our businesses, private equity sort of gets a bum rap for, basically being the vampires of the investment world. They kind of come in, suck all the blood out, and then leave the husk, right? And I think that's sometimes fair. Oftentimes not. And one of the favorite things we love to do is get creative in the portfolio. How can we create opportunities? How can we think about things that no one else is doing? So I think there's more of that going on in private equity than you'd probably imagine. But kind of on the inverse of that, in terms of VC as an asset class, I think it's been, obviously the power laws have really kicked in. If you're, in the top VC funds, you've done incredibly well, right? And, if you haven't, it's a hard game. I would say the, standard deviation of outcomes in private equity are more narrow on the upside and downside, which is it's a safer, it's probably a safer bet as an investor to go down that path. At the same time, it's also getting incredibly crowded. Yeah. And that's one of the things that we try to avoid the crowds and kind of do something a little bit different. But, if you're just doing a, middle market buyout fund that's, mostly just financial engineering, you kind of go anywhere, do anything. It's really tough sledding right now. It's not a good environment, to try to make a living.
Yeah, totally. So if I had to say sort of what Village Global believes about the world that's different than other venture firms, a couple of things I might think are that we think broad portfolios can have better returns, and might actually be better for founders than smaller portfolios, because you have this network of other founders and you have network effect like YC does, for example. That's one thing we might believe. And then we also might believe, or we would say that, founders can make great investors. And so we empower them and with capital. what would you say, because you have a sort of a different kind of private equity firm, are the core beliefs that you differ from your private equity peers?
Yeah, so I would say that being operators and not sort of financial engineers, we just come at it from a completely different perspective. I mean, we get crap all the time that we don't put debt on these companies. They're like, that doesn't make any sense at all. Why in the world would you not put debt, right? Because if things go well, you put debt on something, the returns are going to be higher for the equity, right? Yep. It's not complicated. Debt's an amplifier. It's not a source of returns. It's just an amplifier of returns. And so for us, though, it kind of comes down to, how do families make money? Families make money by being good operators and not being by financial engineering, right? And so we think that that's a really smart long-term strategy. And I think that's, again, our capital is so unusual. We lock up our capital for 27 years, which is just unheard of in the private equity world. And in fact, it's so unheard of that when we talk to some prospective LPs, they literally can't understand. They're like, oh, there's off ramps at like year 5 and year 10. We're like, no off ramps. No checkoffs, like it's 27 years, and there's even an option to renew for another 25 years at year 25.
And so why would LPs get behind that?
Well, so LPs get behind it because it offers us the ability to offer a completely different product, right? I mean, at the end of the day, why is private equity treated differently than any other business, right? Every other business, you're trying to create a better product to serve your customers in a better way, and the value is going to accrue to the people who can do that. I think in private equity, for some reason, it's almost the inverse, where it's like the companies, the deals are supposed to serve the private equity firm instead of the private equity firm serving the customers. And so what we look at it as, we're completely focused on our customers, which we believe are sellers and leadership teams. And so we tell our investors, you're not our customer. We're not optimized for you. Now, if our true customers, our sellers and leadership teams, win, they're going to win really, really big, and we're going to win, right? And so everyone wins as long as they win. No one wins if they don't win. And so I don't understand why you wouldn't be more focused on them. And so in terms of things that we believe that financial engineering, while the capital stack's important, we believe it should enable creativity, it should enable flexibility, and really optionality long term. And what that really looks like is, if you got a huge debt load on a company, where do you think cash flow has to go? Well, it has to go down to paying off the debt. I mean, it's not complicated. So if you have, let's say, a business is cash flowing $10 million, right? And you have $50 million of debt on it. Well, almost all that free cash flow is going to be going to pay down that $50 million debt. Whereas in a business that doesn't have that debt on it, well, now you've got optionality. You can distribute out the cash to the investors, which we do biannually. Or, we look for high return, high probability opportunities to deploy it back into the portfolio. I mean, for obvious tax reasons, it's really advantageous. And, if you've got operators that, it's kind of a virtuous cycle that's created. The more investment back in the portfolio, the more employees are excited about what's going on, the more you can break new ground, the more you can see new opportunities that no one else sees, the more you become a magnet for those things. And so it's really a virtuous cycle. And so, long term, what we like to see is just a good, solid, compounding, both within talent, opportunities within these companies. And the only way you can do that is if you organize your capital structure for the long term, which basically no one in private equity does.
Right. It's really interesting that you focus on the customer being the, not the investor, but the leadership teams. Because in venture, there's sort of this question of, is the LP the customer, or is the founder the customer? And I think in practice for many, the LP is the customer because they hold the capital. And so the tail sort of wags the dog in terms of you needing a strategy that aligns with what they're looking for. And basically, right, there's all this talk of founders and VCs being misaligned because, VCs need unicorns. They have portfolio, founders not having, diversity portfolio, and thus needing to go big or not. But I actually think that might be driven more by LPs, because LPs need the VCs to also go big themselves, because everyone is diversifying upon someone else's concentrated strategy. And so interesting to hear that you're thinking about that at private equity as well.
Yeah. I mean, I think that it plagues, virtually, every area of finance, is this just complete misalignment between the capital and the objective. And, I understand why LPs do it that way, right? I mean, we had one LP, prospective LP, that said, 27 years, like, in 27 years, you're going to be on your fourth marriage. You're going to have stepkids. You're going to be like splitting your time between your vacation homes, and I'll be dead. Right? And so like, no, I'm not going to invest in you. Right? And when he said that, like, I can't fundamentally, if that's your viewpoint of the world, like, I fundamentally can't argue with that. Now, I hope none of that comes true. Right? But it's the exact same thing. Why do PE people or VCs or whoever it is in the finance world act the way they do? Because they're incentivized to do that. If you're an LP and you're giving, money to somebody that's hogtied with all kinds of perverse incentives, what do you think they're going to do? Are they going to be like, well, you incentivize me to go and gather more capital, but no, I'm going to keep my funds small. Yeah. Well, that doesn't make any sense. So why do you keep creeping up? In private equity world, I joke that our best competitors leave our segment of the market because if you're really good, you don't stay buying smaller companies. You get a bigger and bigger fund. You go up market. You raise more capital. You have more fees. You do bigger deals. Like, it's just a natural progression. So it's actually beautiful for us because literally our competition leaves.
Yeah. And do you think that, 5 years out, 10 years out, we're doing another edition of this podcast, the LP ecosystem, or at least the sort of incentives here will be similarly misaligned, or is there some major change that could happen that would?
Yeah, that's a great question. So we're seeing in conversations we've had, we are seeing a softening to alternative structures. I think the challenge is it's going to be much more slowly to take shape than I initially had thought. And it's really just driven by career risk, right? I mean, if you're an LP and you're incentivized based on how well your portfolio does, private equity and traditional private equity is basically the surest bet you can get into, at least widely considered to be the surest bet you can get into to drive your returns. So everyone wants to pile more money right now into private equity. And they're doing it under the same 2 and 20 structure or something, very similar to that that's always been done because it just reduces friction. Like, it's just something you don't have to think about. So really, I had one prospective LP say to me, look, I didn't really even need to review any of your materials, and I didn't, to be completely frank. And I'm like, okay. And he said, but it really doesn't matter because all you people do the same thing. You go after the same businesses in the same way. And so just tell me what your team's like, and that'll be the differentiator. And I was like, I mean, look, I think our team's amazing and differentiated, but like, there's a lot about our business that's completely different. And I think that's very novel, right? So the fact that we're inbound only on our deal flow, right? Very, very unusual. We joke that we're the only direct to consumer private equity brand in the world, right? If you ask most people who Carlyle is, they're like, I don't know, don't they make clothing or something? Like they have no idea, right? Carlyle is like a mega multi-billion, tens of billions of dollars of capital, right? People have no idea because there's no consumer facing effort at all on that side. When it comes to our fee structure, we do we take no fees of any kind, no reimbursements of any kind, and we split the free cash flow above a hurdle. Well, our joke to LPs is if you can buy beer with it, we charge for it, right? And so, there's a lot of things that we're doing very differently, but the sort of cynical, and to be honest, the appropriate thing is that guy, when he told me that, is 99.9% of the time, he's absolutely right. So where's the change going to come from? I think it's going to come from the people that don't have career risk, that aren't worried about, sort of making the next thing look good for their careers. And, there will be a slow over time change, but for the foreseeable future, I don't see it happening fast.
Yeah. And how about the intersection between venture and private equity? Or is it, much more growth capital? How do you think that plays out, and how do they, venture and private equity interweave or in fact become more distinct and disparate?
Yeah, I would say to me, it's kind of like there's two separate paths. One is what I would call a broken VC process, right? Which can kind of lead into more private equity style investments. Or is it just follow on capital that's getting sort of more and more necessary based on just the size, right? And I think you're seeing a lot of VC firms kind of butting up against in their larger sort of Series D, E, pre-IPO type funds, bumping up against private equity, that have historically been the capital providers kind of in that segment. But I think there is actually a completely different sort of broken VC path, if you want to call it that. Or I wouldn't say broken VC path. Maybe it's people who never took on VC in the first place, who could have. That then they get to a point where the business matures, it's kind of topped out. When I say topped out, it can still grow 10, 20% per year. But as you know, if you're not growing way quicker than that, it's not really a venture sort of fits the eye of most venture investors. So I would say those are kind of the two. Where they merge is ultimately different businesses need capital differently at different times, and there should be a rich ecosystem of capital providers that offer just different things. I mean, one of the things that drives me crazy is, politically right now, private equity is like the whipping boy of anybody populist, left or right. I'm not trying to call out one end of the spectrum. And by the way, that's very logical, right? It's big bad private equity. It's Wall Street, right? It's a bunch of fat cats, and they make a bunch of money, and they've been responsible for very visible failures, right? My argument is that sellers, somebody sold that business to private equity. It's not like sellers don't understand what they're selling into. The docs are very clear what debt's being put on the business. The strategy's clear before you close. It's not like they walk in and they're like, guys, I'm ready to operate this business for the next 30 years. And they're like, well, actually, we're going to, lever you, strip you, and flip you. Right? It's like, well, of course that's what to be expected. And in exchange, that seller's getting a gigantic check at close, right? But it's like this, oh my, how dare they? I had no idea this was going to go on. And look, there are plenty of extractive owners of businesses out there, and there's plenty of wonderful owners of businesses. And I think that same thing in private equity. I know people who are fantastic owners in a private equity structure, separate from Adventures, and they do a great job, and they're honorable people, and they try to treat people really well. So there's always the spectrum. And I think that ultimately a good ecosystem, whether it's kind of the blend of VC up to PE, is there's a lot of things that we can learn from each other. In fact, my meeting earlier today here in the Valley was about that very thing. It's a gentleman who's at one of the top VC firms in the world here in the Valley, who is really interested in bringing kind of almost a tech transfer to private equity. And so he reached out to me and said, hey, what do you think about trying to, partner on some of the portfolio, trying to look at this? And we're all open to it. That'd be fantastic. We want these businesses to blossom. And I think there's a lot that the two groups can learn from one another in how to structure the capital as well as what to do with it post-close.
Yeah. Just to take our round two as a framing for the next, 5 years from now, 10 years from now, are there other fundamental changes to the asset class in private equity that you expect to happen either to the asset class itself or to how it's perceived?
Yeah, well, so I think there's been a big influx of private equity tourism is how I would almost describe it. I think this is anytime you get late in a cycle, which by the way, no one knows how late we really are in the cycle. What Australia's in its 29th year right now of expansion. So, when you start screwing with monetary policy the way we have, I don't think anybody knows what the future holds. But, it certainly is showing signs in some ways of being late stage in the sense that, hey, a bunch of money's been made. People are attracted to those returns. If you get into the private equity business and you can raise some capital and you can put it to work, you get paid well to do it, right? No bones about it. And so there's a lot of tourism that's going on from what I would say, search funds, fundless sponsors, family offices are trying to quote unquote get operational. And it's interesting because they usually close one deal and then get stuck, right? Even if the business goes well, these businesses that we're involved in require a tremendous amount of involvement. These things don't quote unquote run themselves. Now we have great leadership teams. They're fantastic. They do a great job, but they're hard businesses. Operating a business, as you know, preaching to the choir here, it's hard. It is a messy, messy world, messy people. And the businesses are just collections of these messy people. And so, I would say over the next 5-10 years, at some point, there's going to be a washing out where, you just can't run around as a deal guy and try to get deals done and get any traction. Whereas right now, there are people who are getting stuff done that I frankly, it blows my mind they're getting it done.
Yeah. And in a downturn, what happens to the asset class? Is it the winners keep on winning and there's a whole lot of losers, or?
Well, it's actually really interesting. So the debt provides the biggest challenge. So if you look at, most of these businesses, at least immediately post-close, are levered at least 4 or 5 times on their earnings, or not even their earnings, on their EBITDA. And you're starting to see larger deals get 6, 7, and with mezz 8, potentially even 9 times, right? And so there's a very small amount of equity going in and a large amount of debt. If there's any downturn in the business at all, there's just not much room to go anywhere. So I think you're going to see a lot of those types of businesses implode. There'll certainly be a buyer's market for sort of good businesses that have just had the wrong capital stack put together for the situation. Now, no one knows when that's going to happen though. And that's the issue is if everything, we may be 5 years in and we're having another podcast and saying, boy, the last 5 years have gone great. And things continue to go up and to the right. And we surely have to be late in the cycle, right? So, since no one knows, I would say that the biggest issue is just going to be the washout that occurs naturally. It doesn't take much of a downturn if you're levered up, even, 4 times. If you're levered up and you dip 20%, you're out of business. And I think that's one of the things that we think, our strategy doesn't make nearly as much money on the upswing, right? Because we're not levering the equity, but it's way more durable. And, our business, if we have a $10 million free cash flow business that goes down to 3, we're still making $3 million a year. It's fine, right? And we can keep operating. And by the way, we'll probably be a consolidator of talent. We joke that we'll be the mosquitoes of the nudist colony the next time there's a downturn.
To understand sort of the macro stuff, is there an economist you swear by, or whether it's a Carlota Perez framework or someone else who you really look to understand, or is it, hey, I'm focused on operating these businesses and we'll let the macro, take care of itself?
We definitely look at the macro just to make sure we know what's going on. We try to be, following along with trends, but everything that we do is so bottoms up, right? We're trying to look at these individual businesses. We've gotten a good, nice, I would say 10-year snapshot now that's, since the last downturn of kind of how does the business perform in a downturn, coming out of a downturn? What are the new innovations in the business? So it's much more like, we're going to underwrite a business. I can't imagine a business that we would, well, actually, to be honest, we declined a business the other day that, was a major supplier to an electric car manufacturer. I'll keep it very broad. And, they had 70% customer concentration, and they're providing a mission critical part, and the business had just exploded in revenue and profitability, not surprisingly. That is something that we had significant concerns with from a macro perspective, and just from how the customer was being organized from a capital structure perspective, and it's just not a risk that we felt like we could take. And so that's a good example of something that was sort of more macro-y,
right,
that affected the micro.
Totally. One trend we're seeing in venture is, instead of raising equity, people are sort of Clearbank, et cetera, is sort of introducing these new financial instruments where people can sort of raise money against their marketing spend, sort of, as a loan. Is that something that you think is super interesting, going to be much more popular, make a lot of sense?
Yeah, it's a model that's been around in the private equity world for a long time. This is, kind of new to venture. This has been around for a long time for small and medium-sized businesses. Factoring receivables, which is, sort of very similar. You're taking an asset that's, more of a long-term asset, or at least longer term, and you're, front-loading the cash, and then you're taking as something comes in, right? So, this business model's been around for a long time. I think the innovation that's really cool. I'm a huge fan of anytime you can, do well financially, making an investment, and help the ecosystem at the same time. This ability to plow more and more dollars back into sort of science-backed, data-driven marketing strategies totally makes sense, right? And this is something that if you know that, you can put in $1 and get out $2, and, the dollar that you're putting in carries what seemingly would be an onerous, interest rate, you don't care, because you can churn those dollars so much faster. You can grow the company so much faster. I think that the danger, of course, is if you don't get your math right. And I've seen that up close and personal in a few investments that we've seen through the years, and it's not a pretty sight, as you know. And so I think, I would just say is that in that case, I hope the underwriters at whoever it is that's providing the debt would almost be like a VC, in the sense of have the expertise that they could say, hey, we do think, after underwriting your business model and your data, that we think that you should do this, as opposed to how much capital can we cram down and somehow sort of take the equity in return. I think that'd be crappy.
Totally. Let's talk about your investment thesis at Adventur. So you have seen tens of thousands of companies. How do you sort of talk about or think of internally for what types of companies you're most interested in, or what types of sectors, or what's the sweet spot?
Yeah, that's a great question. So we're fairly sector agnostic, in the sense that we believe every sector has sweet spots of value. So if you're going to look at like the wine business, right? Everyone thinks about, being the winemaker, and it's the sexy side of the industry, and you can put your name on it and it's a prestige investment. They're really terrible businesses. Like as a whole. Of course you're going to find outliers that have succeeded, but in general, what's the thing, how do you make a small fortune in the wine business? To start with a large fortune, right? And so, what you would look in the wine industry and say, okay, we're not just going to touch the wine industry. It's just a terrible industry from an investment perspective. Tastes delicious, investing wise. But look, as you go down the stack, I mean, who are the people that make the foil that go on the bottles? Who are the people that make the bottles? Who are the people that make the corks? Who are the people that transport the wine, that store the wine, that, wholesale the wine, that, all these different aspects of any industry where I think it's dangerous to look at, sort of a sector and just write it off completely, right? So what I would say is that we're really, we try to be bottoms up in how we approach things. We're trying to look for those unusual niches within the industries that maybe are overlooked or seem odd, or just there's something unusual about the business that is different than maybe the just commodity on the surface. And so, that's kind of the tie that binds. I mean, we've got, businesses in the pool industry, military recruitment, matchmaking is another investment that we've made recently, which we feel, great about, super excited about.
Matchmaking as in dating?
Wait, not dating. It's matchmaking. There's a big difference there. I want to correct you. No, I'm just kidding. Yes, in the, like dating, matchmaking, that side. Aerospace, glass and glazing. I mean, it really spans the industries. I would say there's certain things that we like more than others. So for us, we like to see things that are going to be around for a very long time, right? So we always have a kind of a broad thesis that we go with. And I mean, glass and glazing being a good example. Like, glass has been used and increasingly used as a building material. I don't see glass being used less. I see it being used more. Right? And so we like to get into things where we think that sort of organic demand for what they're going to have is going to be up in the future, and that they're going to be able to play a critical role. And any innovation that's going to occur in that industry, we want to get ourselves in a position to be able to sort of maybe not be the bleeding leading edge of that, but being, really close followers and watching it closely, kind of what develops out of that. So for instance, in the pool business, we were one of the first people. In fact, I think we were probably the first group in the country to introduce 3D pool view. So you could actually put on 3D goggles and like walk around your backyard and like, hey, what steaks do you want on the grill? Like, what color's your dog? Like that type of thing that you can have, which really gives people a visual experience of what their backyard's gonna look like. So those are examples. I mean, it's a very blue collar business, right? I mean, we're shooting holes in the ground with concrete.
Right. And what's the financial lens you look on is there like, hey, this needs to be, XX, or like we need to believe we can get this kind of return on each, or how do you sort of?
Yeah, I mean, certainly we have financial hurdles that we have, and those are kind of always shifting around. I mean, in general, we want to look at what's the historical growth of the company, and then what do we think we can do with it. Yeah. And you can always, if you want to destabilize the companies, you can always do more with them, right? What we typically like to do is we like to partner with the people that are in the companies, and we don't like to, bring in, sort of the squad to come in and descend upon the company. I mean, we try to, be kind and generous and sort of very collaborative with how that works. And at the same time, I mean, like I said earlier, the primary role is to serve them. Yeah. And if we serve them well, they'll serve us well. And so, yeah, I mean, I would say that those are kind of the lenses we look through, and it's always different in every investment though. I mean, you have investments that, have a lot more upside, and, sometimes that comes with a lot more downside as well. And so we're always trying to calibrate kind of what's the risk adjusted return that we're expecting.
Yeah. The pool, you mentioned a bunch of industries. I'm curious, earlier before that, you mentioned sort of niches that were overlooked. What are a couple examples of industries where you felt a certain niche was overlooked and maybe you made investment in there, or maybe you just looked at it a lot that, hey, there's something interesting there?
Yeah, well, I mean, I would say to use selective search, which is our investment in the matchmaking space. So I've long been interested in sort of how has the flow of information, obviously apps, internet to apps, kind of how has that shifted and altered the dating, marriage world, right? And so if you kind of think about it in terms of the stack, you have, kind of the tenders and more mass, at the very bottom, right? Yeah. Which are either free or very cheap. And then you have, the highest end matchmaking firms in the world, which, selective search is, I think far and away the highest end in the United States, North America, at the very top. And so, what do you get with them versus what do you get with a tender, right? Well, with them, it's an executive recruitment model. So you're getting a team of 5 people. They have a proprietary database. They're putting you through like personality testing. They're then, identifying candidates based on, whatever you think's important. And they're really trying to help you vet what you say is important, versus what's actually important.
Is the compensation outcome based?
The compensation is not outcome based, and that's for a very good reason, right? They're excellent at what they do. They have an 87% success rate, which means 87% of the time that somebody signs up for a single contract, they end up with in a long-term committed monogamous relationship, right? Which is an astounding success rate, right? I think 34% of the time, the first introduction they make is the one. I mean, again, that's just unbelievable for people that have gone through. I mean, one of my buddies, I would say hundreds, if not pushing thousands now of interactions. I mean, that's really becomes attractive, right? And so, I think that's a good example of like when you think about the dating world, you think of it as being oversaturated. I mean, you're having these sort of niche players now come in, but pretty much Match Group now, controls a huge chunk of it. And you look at that and you say, is that really an area we want to play in? But then you look at the highest end, and it's really a misunderstood marketplace. So, I mean, it's chock full of kitschy, less professional type people that are sort of the local matchmakers, right? And they, Millionaire Matchmaker was a TV show, right? Hitch, like if you think about it from a movie. And so these are the things that whenever we first saw the opportunity, I mean, these are the prejudices I brought to the table. And then we met this incredible team that was super serious about what they were doing. It was not a hustle. It's incredibly professional, right? They're all very well educated. They know exactly what they're doing. And they're taking a very tried and true model, which is the executive recruitment process, and applying that towards finding love. And so that's an example of something where I would initially, even when I first saw it, I was like, no, there's no way, right? And then the more you dig into it, you're like, that's a really interesting niche. And now we have this ability to kind of create cascading product lines down where, the top product starts at $25,000, right? Which sounds outrageously high, right? Until you realize really all the things you're getting, and it gets a lot cheaper. Yeah. And you think about also is like to find for health and wellness and like sort of longevity and quality of life, like finding somebody to share your life with is like the most important driver of all those things, right? So to spend $25,000 in the grand scheme of things on that, then it starts to look cheaper. But now we know that that's not affordable for everyone. So then you start cascading down alternate products, right? And I think that's something that we want to do over time, while keeping that, sort of same level of service up. And so, yeah, it's just an example of like, I learned so much, continue to learn so much. And, gosh, I have a great job. It's so much fun.
Totally. So you mentioned you want to work with leadership for the long term, but how do you think about succession generally, and how do you advise leadership teams to think about succession?
Yeah, well, so it's a fact of life, right? We're not immortal, and so we always have backup plans and sort of backup plans to backup plans. We consider succession planning to be a critical piece of any business, and unfortunately, we had to kick that into high gear in this last year. We had TEPCO, which is one of our portfolio companies, the classic lazy business, headquartered out of Dallas with Oklahoma City and Las Vegas offices. Bill Keene, who's just a delightful guy. He was the majority owner when we bought the business, and he got diagnosed with terrible illness, and we lost him this year. And it was really, really hard. I mean, I was actually telling one of my colleagues today, I miss hearing his voice, right? And the business has thrived despite it. And I think it's a testament to planning ahead. I think it's a testament to his leadership that he was able to identify just really talented people who are now leading the organization and just doing a phenomenal job. I mean, and I think that, oftentimes we're all people, right? And we want to feel special. We want to feel important. And I think that oftentimes clouds our judgment on how we think about succession planning. If you feel like you're not necessary, right? Like you've done all this work to make yourself not necessary, then somehow you feel devalued. And I would say we encourage people to feel the exact opposite, right? If you could somehow get hit by a bus and, the company doesn't miss a beat, right? Yeah. Like what a testament to your planning and how thoughtful you were. And it should be, edifying and not something that makes you lose confidence.
Totally. And I'm curious for the deals that you almost invest in. I'm curious, what are the characteristics of those companies that you almost, but can't get there for whatever reason? For example, in venture, it's, hey, we think it's a awesome technology, but it's too early for the consumer, or we just don't think the market is big enough to receive venture returns, or we think the founder is likely to sell early or something. Like, those are some examples for us. What do you think of private equity, or some examples where you're, eager about it, almost going to pull the trigger, but you just can't get past this one thing?
Yeah, well, so for us, we have a kind of a very different set of challenges than you all have. I mean, we have history on the firm, and these are profitable companies that are successful, and there's meat to them, and so a lot of the things you just talked about. I mean, kind of we're taking the executional risk in that way kind of off the table. The biggest issue is people. It always comes down to people, and we try to get to know people in a way that I think is maybe unusual for the private equity business. I mean, we don't look at these as just being transactions. I mean, if we're going to be involved in these companies for 10, 15, 20 years, these people become our family. And I mean, we want to treat them well. We want to treat them as family. But it's really hard to like sort of have a shotgun wedding. And this is where, we just don't do well in I would call traditional M&A processes where it's like, okay, you, maybe get one management call and then you submit your offer and then you get a 3-hour scripted site visit and then you're supposed to like go under LOI and close in 60 days, right? For us, we're like, where do we get to know the people and like get to dine with them and get to know their families, and we have them to Colombia and we go to wherever they are, that type of thing. And it's just really hard in a traditional process. And so oftentimes what we like to do is take things more slowly. I mean, we certainly have moved quickly on certain opportunities, but just really spend the time and get to know the people. The numbers are what they are. I don't think there's any, the trajectory is very well known, right? And so the question is, post-close is, how are these people going to be worked with? We all have nutty stuff, right? We all believe crazy things. We all have picadillos and weird things about our personalities, how we like to work, how we communicate, what sets us off. And so, it's much better to know those things before you get into a very deep relationship, than just being kind of going in blindfolded, eyes closed and saying, I don't know, we'll figure it out. Right. And so, yeah, I think that, so post-close, the way traditional private equity deals with this is they just kind of wholesale replace leadership and they put their own people in. So it doesn't really matter to get to know them. For us, since we are going to be partnering with leadership, we have to get to know them. Yeah.
And do you think that, or do you have any sort of non-obvious insights on ways on how you quickly get to know people, or like sort of a subconscious maybe checklist of things that you're looking for when evaluating, hey, is this the team we want to partner for 15 years?
Yeah, I mean, I would say, so it's really hard to look at somebody's actions. I mean, I think you can look at the same action or the same result and it can mean very different things. And so what we're looking for is consistency between what they say and how they behave. And, that sounds like very, Sherlock Holmes of us, right? It's not. It's just having conversations with somebody. And, so often in the business world, we tell each other what we think the other person wants to hear. And that's just not the way to build a relationship. And so, many times when we first get to know somebody, they're nervous. We're maybe a little nervous. We say stupid stuff or they say stuff that they don't believe. And you try to get to the bottom of sort of what do they really believe? How do they make decisions? And how does that impact everything from their personal life to their work life? How have people blossomed underneath them or not? Are they more command and control? Are they more decentralized in their decision making? And by the way, anything can work. Right? I mean, there are very few attributes. I mean, we've bought businesses from people that have really fancy cars and houses and live a very high lifestyle. And we've bought, very, very, sort of blue collar business from very blue collar and sort of have no interest in those things. Being one or the other doesn't make you quote unquote better, right? Doesn't make you a better fit. It's just being true to who you are and sort of the predictability. It's almost like you're building a brand, right? Which is just like sort of the predictable range of outcomes, right? That you could expect. You want to deal with that personal brand. When we call up somebody, what are we going to talk about? What are they going to focus on that doesn't really, we all do this, by the way. What really doesn't matter, and then what are the things that they're not going to focus on that really do matter? And, sometimes you're going to be pushing people and pulling people, and other times, you're just really, there to listen to them and help them in being emotional support. I mean, we're all human. And I think that in business, so oftentimes we try to strip that away, and it's just dumb, right? I mean, embrace people are people.
Totally. And how do you, in venture right now, there's this big sort of debate of, what is a tech company? What isn't a tech company? How should we, we work where we're sitting, obviously is in the news. I'm curious, how do you guys think about tech innovation? How important these businesses are as it relates to technology and being technology enabled versus business model innovation or how do you guys think about that?
Yeah, I mean, so for us, the business model innovation is probably even less so than I would say in the tech world. I mean, the business model is very straightforward, right? In our glass and glazing business, like we make glass for skyscrapers and stadiums, and we have a certain cost to it, and we sell it and install it, right? And so there's not a lot of it. It's not like we're going to go to them and be like, we would like to put you on a recurring revenue plan for your glass, but if you don't pay us, we're going to pull the glass off your building and repo it or something like that, right? There's certain business models that work, in different situations. I would say for us though, there's always these amazing opportunities to get better at basically every area of the business, right? Whether it's warehouse management or how do you organize a manufacturing facility? How do you communicate better? I mean, a lot of these are just soft skills. I mean, as dumb as it is, like how quickly do we call back customers?
Yeah.
I mean, that alone right there could be a major source of return over time, is just coming in and saying, look, instead of calling them back over a 3 or 4 day period, why don't we call them back within an hour? Right? That sounds like a radical shift, but people pay attention to stuff like that. So there's a lot of these, joking ahead of time, we call it like the table stakes of business hygiene, right? That sort of like in marketing and advertising, in sales, in technology, in operations, in finance and accounting, kind of what are the things that every business should be doing sort of at a minimum to compete in the marketplace. And the interesting part is I've never seen any smaller company that does all of them well, even come close to doing them all well, right? I mean, we have this phrase, small businesses don't stay small on purpose. There's a reason why they're small. And I think that's where, we try ahead of time to understand sort of what are the lids on the businesses and where can we, maybe help or assist. I mean, oftentimes it sounds like there's some like grand strategy. And I think this is where it's much more mundane than that. It's more of like, how can we help get them in a position to maybe think about how to scale themselves, create more time, more headspace to be able to pursue things that seem obvious. They've thought of them too. It's not like, very, very rarely do we come into a company and say, have you thought about X? And they're like, we have never thought about that. And it's going to unlock all this value. I mean, oftentimes they're like, yeah, we talk about that all the time. Who's going to do that? Right? And so then the question is not, okay, great. We all agree on the strategy. Yeah. Now, how do we execute? Well, it's hiring the right people. How do you find the right people? What talent networks do you have access to? Who wants to go work in that type of business? And I think this is where small businesses just unfortunately have this really bad selection bias, right? Part of it's perception, part of it's reality, that if you really know what you're doing, let's say I'm just going to, pick an area of discipline, marketing and advertising. If you really know what you're doing in marketing and advertising, are you going to work for a local plumber? Of course not, right? You're going to be working at a major company. You're going to be working much larger. If you're a consultant, right? Do you work, all things being equal, do you work for smaller companies for less pay or larger companies for more pay? All of this is just about how do you create more value all around within the ecosystem as opposed to being extractive and trying to take as much you can out of it.
Right. I'm curious to get into the bottlenecks that these companies face. So talent is the biggest one, would you say?
Yeah, I would say talent. I mean, talent is by far the biggest one. Financing, having access to capital, I would say is right up there. Mostly access is maybe the wrong word. It's how do you package the company in a way that gets you access? I mean, oftentimes we'll come in and there's just an aversion to using even a line of credit, right? Now, we're not even talking about like senior debt or mezz debt. I mean, that's like way advanced compared to where they are. And private equity, by the way, would call that kind of child's play, right? I mean, we're talking about people who just feel like it's a personal affront to their manhood to pull on a line of credit. I mean, these are conversations we have, right? And I think, we can sit here and laugh at that and say, oh gosh, that doesn't make any sense. But for them, like if you have to pull on a line of credit, it means you're not doing well. It means like you failed. So there's an association with sort of an ability to finance your company as sort of tied to your identity. Yeah. And so oftentimes we'll come in and say, well, look, if we want to, grow the company double and we have a working capital needs, that means that our working capital needs are going to double. Like, how do we fund that? There's nothing wrong with using a line of credit to fund that. Now, if you're using a line of credit to fund losses, yeah, you're in trouble, right? Those are two radically different things that I don't think most small business owners understand how that works. And when you go to a bank, and bank's going to give you what you ask for, right? So we'll oftentimes come in and they have like some super high interest rate, if they have a line of credit or maybe a little bit of like equipment debt or something. The terms are crazy. There's, all kinds of guarantees on it. I mean, and we come in and we're like, no, what are you doing? They're like, oh, do you not want that? And we say, no, give us market standard terms. And they're like, okay. And literally the sellers and the people that we're partnered with now are like amazed. And it's like, that's just because right? It's just access. But I'd say access to talent is certainly the thing.
How do you help that there?
Yeah. So we created something called the Orbit, which we have, I think, a little over 750 people now in Orbit. We're actually hosting an Orbit event and kind of a scout event, which is another thing later this afternoon. And so we try to host these events. And all it is when you join Orbit, you basically raise your hand and say, I'm interested in working with Adventures in one of the portfolio companies. We have people who are recent MBA grads, recent college grads, all the way up to like CEO candidates, almost like people that are retired that want to help more on board of directors. And so we have this, incredible group of people that, we keep quote unquote in orbit. And when the time is right, we say, hey, here's an opportunity. What do you think? And so we put everything from accounting positions. We actually just filled the CEO role, at one of our companies through the Orbit. So it's a great group. And we try to treat them as family. Like, again, the kind of an extension of the firm.
Totally. And you wrote a book called Messy Marketing?
Yeah, The Messy Marketplace.
The Messy Marketplace.
Yeah. But it could be called Messy Marketing. That's actually a better name for it.
Let's plug that a little bit. Talk about what you were trying to do by why you wrote the book and what you hope people take from it.
Yeah, well, so one, I feel like anybody who's under the age of 40 and writes a book is kind of a fraud in some ways, and I'm 36, so I'm going to put myself in that category. We wrote a book because we couldn't find the book that we wanted to give people that was out there, and so the last thing in the world we wanted to do in the last couple years was take the time to write a book, but we wanted to give something. We think about content as a way to scale conversations, and so we wanted to give people something where we could as a seller or the helper of a seller, so the CPA, the lawyer, the wealth advisor, maybe even family member, right? Something where they could understand the process of how do you sell a company? Like, what does it mean to sell? How do you prepare to sell? What's the process look like? What happens after you close? Who are the actors involved? What are their incentives? All these things. And so we were kind of having the same conversations with sellers when they would contact us, because we have a lot of people who don't go through an intermediary, who just, reach out through the website. We had one guy say he had gone on our website, like, I think 10 or 15 times over 6 months and finally drank enough bourbon to get up the courage to, click enter. So we try not to be that intimidating, but we have a lot of people who come directly to us and we try to help them through the process. And we found ourselves having the same conversations over and over. And so we said, gosh, wouldn't it be better if instead we could send them a book? Yeah. And so we did a kind of a survey of all the M&A books that are out there. And there were some very good ones for buyers. In fact, there's the Harvard guys, that run the search fund class at Harvard have a great book on the buy side. I think it's called Buying a Small Business or something like that. And so, but really on the sell side, there just wasn't, most of the books that were out there were kind of a very heavy business card that the logical conclusion was hire us, right? And so, Adventures is mentioned, I think once, maybe twice in the book. It's not about Adventures. It is literally a resource that we use every day to be able to hand to people and say, this is what it's like to sell your company. This is what you need to be prepared for. And there's a lot of preparation.
Right. And one of the things I heard about you is that, among other things, one of your superpowers is understanding and advising people on negotiations and deal making. And so what do you think you sort of uniquely, appreciate about, negotiations or perhaps other people undervalue or overvalue?
Yeah, I mean, I would say I've changed a lot in this. I think, in my younger years, when I was first getting going, I looked at negotiation as very much a zero-sum game of how do you get the most and sort of almost trick the other person into giving up things that they shouldn't give up. I quickly realized that's a really unsustainable way to go about business, and it just doesn't feel very good for either party. And so I would say, now the thing that I focus on is how do you take different circumstances, different interests, and align them through a deal structure somehow to where it creates a win-win for both parties. So where, anytime you turn around, let's say 5 years down the road, objectively it's going to look like somebody got a better deal, right? I think that's a really poor way to look at it. If in the beginning two, mutually consenting adults say, hey, looking at the circumstances, there's not a big information advantage. You're not trying to, pin people down or, there's not a forced seller situation, right? But it's really two parties coming together and saying, we believe there's more value to be created. Like a lot of people, the money that they're getting at close is life changing. I mean, this is sort of all things being equal, I mean, this is money that is forever money, right? The way they kind of think about it. And so could they continue to run their business and over, 5-7 years generate more free cash flow if they'd stayed in it? Yeah, people are tired. They want to spend time with their grandkids. They want to be, they want to pursue other activities and they want to take chips off the table, just de-risk it in general. And so I think those are the situations where it feels very, I don't know. It just feels great to be able to create something where everyone comes together and can celebrate it, right? I was just thinking about the woman who sold us the business, the aerospace businesses in Los Angeles, last month. And we had this delightful, lunch on the patio and we were just celebratory. It was great. There wasn't any animosity. It was just a fantastic, and it'd been a hard process. It was 14 months. It was hard, right? So don't mistake, celebrating for being easy. It was just one of those situations where she was so grateful and I was so grateful and we were both better off because of it. And honestly, beyond us, everyone was better off for it, right? She wanted to bring in somebody to help modernize, the company, and I think we can do that, right? And so hopefully it's about creating more value. And anytime I advise people, so I'll have friends that say, hey, you do a lot of negotiating, will you help me? And it very much feels like they're in that mode of well, if I did this power move on them and they could get this. And I say, no, don't. Life's not a one-time game, right? The world's actually very small in many, many ways. And I think the best thing you can do is just treat people really, really well and try to be kind and generous.
Yeah. And is it similar to how startups should think about M&A, or do you think your type of M&A is very different than how startups should think about it with big tech companies?
Yeah, I mean, it's not my world. So, I mean, I think that when you get into large corporate M&A, I think the rules change in some ways, but I also those people go to work at those companies and they're gonna, I don't think you should be a pushover. I don't think it's not, no one's gonna respect the sort of the patsy at the poker table, right? But at the same time, I think that, being deceptive or being, mean-spirited, it never pays off. You don't ever win as a result of doing that. So, I mean, I would say, and also, you should tolerate a lot from the other side because look, negotiations are stressful. Yeah. This is one of the things that, we talk about a lot as a team at Adventures is, our job is to give people the benefit of the doubt and to not react emotionally to even if they're reacting emotionally, right? There's no value in getting hot-headed about things. Now, do we do this perfectly? Absolutely not. Have I lost my temper? Absolutely, right? So I'm sure there's plenty of people that are listening to this and rolling their eyes that have dealt with me. But at the end of the day, it's never helpful, and I'm never proud of myself when that happens. And I think that's something I would advise too, is just, the numbers are what they are. If they're attractive, if the package is a win-win, do it. If it's not, don't. And there's some great people at some of the big tech companies. There's also some really crappy people at the big tech companies. It's almost like life is messy and there's a huge spectrum of types of people, right? Be on one side, not the other.
Let's go back to evaluating companies for a second. Are there certain industries that you have not made bets in yet, or a bet, but you're really excited about or curious or have looked into?
Yeah. I've said this in the past too. It's the home services area for me. If you look at home and office services, it is highly fragmented. It's got low net promoter score, low customer satisfaction, right? And it just, as far as professionalism goes, it's just one of the lowest professionalism industries. I think it can be it could be very valuably tech enabled. Gosh, we would love to get in. And by the way, we're kind of indifferent. It could be pest control. It could be HVAC. It could be on the plumbing side. It could be on the, energy efficiency side. I mean, there's so many different ways to service a home and an office. We just don't have a wedge in right now, right? And we've probably looked at, literally no joke, we've probably looked at 600 or 700 home services businesses. And the issue is that most of them are tied to new construction. So there's very few pure kind of services driven. And if you're a construction firm and doing services, you're usually going to be construction heavy with kind of a light services component. And that's not necessarily the business we wanted to be in, right? And so we're looking for that right team, the right mix, enough of a stable base that we can use that to be more acquisitive in the future. We just haven't found it yet. And I think that's something that, hopefully, I've been talking about it long enough. Surely enough, somehow it'll manifest, but I'm not quite sure how.
Have you looked at, laundromat businesses before?
Yeah, so laundromats are kind of this interesting category of what I would call as heavy asset-based, real estate-based investment. So I would say kind of laundromats, car washes. There's convenience stores are kind of all in that same spectrum. And I think that most of the time, it's funny because real estate investors get into those and they're like, oh my gosh, they're such a headache. They're so operational. And like the operations of a laundromat compared to the operations of really any normal operating business is like nothing. So it's kind of all what you're used to, right? It's all relative. For us, we think that there's a lot more people that can buy laundromats and car washes and convenience stores than can buy highly operational companies. Yeah. And so, I always joke that, if your dentist can buy it, we probably don't want to. And so that's typically what we've seen in the past. We're not going to buy things better than, there are people who roll up, laundromats, roll up car washes, roll up convenience stores, bundle them together, kind of sell them to REITs and, that type of industry. We typically like to shy away from those. I'd say where real estate type businesses get interesting kind of in the middle is, like restaurant chains, right? Or franchisors, things like that, which are having heavy sort of physical retailers would be another one. Heavy, physical retail presence or physical footprint, but they're fundamentally an operating business that's enabled through that footprint. Right. And so there's always just kind of a spectrum. We probably shy more away from those. You asked, before what we like, what we don't like. I would say we kind of shy more away from real estate, as one of our rules, but we're open to it. We evaluated one of the largest, steakhouse chains in the South recently, and to their credit, it was pretty good margins, and they were doing a good job. And they'd created kind of like a kind of a mini Morton's type chain. So we'll look at stuff like that, but we haven't obviously pulled the trigger on anything like that.
Do you have a certain framework around margins or how they should evolve over time, or other key sort of business fundamentals that if they aren't there, hey, unlikely to?
Yeah, so I feel like all these can mean different things, and that they're all just a single piece of the puzzle. And so if you look at, I'll use kind of margins and I'll use capital expenditures, the capital intensity of the business is kind of being two barometers. If you look at a high margin, low capital intensity type business, you're typically going to attract massive competition. There's no way you can hold high margins and low capital intensity sort of in perpetuity unless you somehow find a niche where you can kind of protect the niche, and it's not going to grow much, but it's going to be what it is. And so you kind of look at that and you say, okay, well, of course we would prefer higher margins than lower margins. We also want to know where in the economic cycle margins go, because there are some businesses that have basically steady margins through full cycle. There's other businesses that, their margins will literally triple up cycle because you just can't get access to the thing that they're doing. But in down markets, they have no choice but to lose money to survive. Those are obviously going to be treated very differently. So you can't look at one snapshot in time and look at margins and kind of make a deduction based on that or have a hard rule. Similar to CapEx. CapEx, capital expenditures, what, equipment you're buying, how you're expanding maybe a physical footprint or whatever it be. Those things can be, very, very nice returns on lots of capital sometimes. Or they can set yourself up if you, look at only a snapshot for a huge fall if you've got a big asset base and then you're, sort of a big capacity and then your demand falls off. They can just suck cash, right? And so sort of the higher the capital expenditures, typically the higher the risk. You also have to look at what you're actually buying. So if you're buying very liquid equipment, stuff that you could easily buy and sell, like if, let's say a fleet of trucks, right? That's a different type of capital intensity than we're going to put $6 million into a plant where if we don't use it, no one could use it. Yeah. So, all these things, again, what you're trying to do is you got a puzzle in front of you. You're trying to figure out, okay, where do you sit in the hierarchy of the industry? Where are you protected? Where are you vulnerable? Who wants to compete against you? How quickly can they compete against you? How much capital would it take to compete against you? And if you feel pretty insecure that somebody could come along and just spend more money and do what you do, it's pretty dangerous to get into that business. There needs to be something unusual about the business. Again, moat, competitive advantage, whatever that you want to call it, that keeps the business insulated from that competition.
Yeah. And so in venture, we're starting to see, companies, especially with SoftBank, that are trying to use basically capital as a moat. And then, of course, there's traditional data moats. There's sort of questions as to whether how sustainable brands are as a moat. How do you view moats that excite you or moats that don't excite you in terms of long-term defensibility? And how do you think about relative to others?
Yeah, well, ironically, obviously we're at a SoftBank, now owned company, I think, here at WeWork. And I think that, there's a lot of things that, this is nothing new, but you can mask a suspect business model with a lot of capital. And then sometimes you should use a ton of capital to hit the J curve, right? I think the same thing kind of happens in private equity sometimes where, you get this idea of like, it cracks me up every time I hear somebody saying like, have you ever thought about rolling up fill in the blank, right? It's like, well, yeah, if you take a bunch of small things and then you just slam them together, like it sounds really sexy. Like think about all the synergies we could create. The problem is you take a bunch of like small crappy businesses and you slam them together. Now you've got a really, really crappy big business, which is, baling wire and duct tape together. Now you could spend a bunch of capital to roll it up. You could create this layer of, management above, have all these training programs. And some people have done this moderately successful. I mean, some have done it quite well at it. It's just really, really hard to do. And it's, a lot more things, work in theory than in practice. Yeah. And so we're just very skeptical of things that if it hasn't been done in the past, if you don't have a sort of a track record of doing it, the joke is every projection like changes up and to the right as soon as we buy the company, and all that changed was the ownership. Yeah. And we're like, well, wait a minute, if that's the case, then why don't you just keep it? And they're like, oh, because you'll do so much better with it, right? Like, no, we're not. Yeah. No, we're not. There's no way.
Totally. And you mentioned the different elements of where you help companies, marketing, sales, finance and accounting. Let's name maybe a couple of the most common or perhaps non-obvious mistakes that you see leadership teams make that you make sure to help. Talent was one, not mistake, but, resource that a lot of companies don't have. What are either mistakes or things that you help companies do a little bit differently or better as it relates to marketing, sales, or?
Yeah, I mean, I would say that there's kind of two buckets. One is giving yourself margin to think about how to work on the business and not only in the business. And this is just something. Look, I joke that operating a business is a daily knife fight. In fact, we called the weekly newsletter we sent out the knife fight until we got enough people who told us that makes them feel anxious. And then we changed the name, and then we had a whole bunch of other people who said that was the perfect name and we shouldn't have changed it. But anyway, and so I would say that one category is just getting yourself up out of the weeds, thinking strategically. And this sounds far sexier than it really is. Thinking strategically is just like, what is the logical things we should be doing, but we're running so hard and in so many different directions that we just haven't thought about doing, right? And so we're able to have those conversations, certainly provoke them sometimes, but oftentimes just be a sounding board and a thought partner to them in that way. I do think there are some niche expertise that, again, it's just really hard to get access to. Yeah. So, on our staff, we have a really legitimate technologist, right? Who thinks, about systems and how to use technology and build systems. We've got marketing and advertising people. We've got finance and accounting people. We've got people who are focused on operations. I mean, things that you just don't know what you don't know. And so oftentimes we can't help. I mean, let's just put that on the table, right? It's not like we're coming in and like waving the magic wand and all of a sudden every business's problems disappear. Like the problems are still the same. Yeah. But, when it comes to benefits renewals, for instance, like we know what the market for benefits are. So when, their local provider who they play golf with comes back with a 33% increase, which by the way happens almost every year at one of our companies, we say, no, thank you. And here's, by the way, if you're not going to do this, then we have somebody else who will. Like we're bringing in sort of, I guess I would just say in general, like raising opportunity costs and pointing out sort of things that if you had been an expert in that, it would be obvious, but maybe just aren't obvious to somebody who's, again, running 100 miles an hour and doing a tremendous amount. I mean, it is yeoman's work that these people are doing. I don't want to give the impression at all that we're somehow like smart and they're not. And like, that's the exact opposite. In many, many ways, they are incredibly far superior at what they do than we could ever be. Yeah. And in fact, like we think, we don't understand private equity firms sometimes come into these companies and say like, have you thought about redoing all of this thing with your operations? And it's like, these people, you have no idea what you're doing, and these people know what they're doing, and they've been doing it for 30, 40 years. Like, how in the world are we going to come in and help them make glass better or recruit people for the military better, right? Or do any of that? Like, there's no way. Now, what we can come in and say is, hey, you're really good at this. There's this kind of meta layer, like I call it the everything tastes like chicken layer, right? To business, where it's the business of business. That many people who are technically excellent at what they do just haven't been exposed or don't have the access to talent or just are too busy to even focus on it. That's where we can come in and offer some expertise and help.
Totally. And, I started this podcast by asking you sort of what has thread your career, what's sort of the underlying thread of your career to date. I'm curious, looking forward, one way I'll ask this is, what do you want sort of the unique contributions page of your Wikipedia page to say, 3 decades from now or something in terms of
Yeah, well, so no one's gonna know my name in 100 years. I'm okay with that. But in terms of legacy, I mean, I do think there is a better way in the private equity business to go about transactions than the traditional LBO model. I think there's a much better way of treating people than private equity is used to treating people. I think that, it sounds so fundamental, but just treating people as people, like made in the image of God, like we're special, right? And like we should treat each other as special. Yeah. And I feel like too often in business, it's, we're numbers or we're, overhead costs. And I mean, I've seen up close and personal what it looks like when somebody treats people not as people, and it's just not pretty. And so I think that would be just the thing that, bringing more humanity to the industry. I'm not saying this is not like we're better. We got plenty of problems. Like I can be a pain in the ass. So I'm not saying that at all, right? What I am saying though is I think there's a better way, and I think that we can serve the families, we can serve the communities better at the companies that we get involved in, and that private equity in general could do better by maybe not putting as much debt as you possibly could on a business. And there's plenty of private equity firms who don't do this anyway. But I think that maybe also restructuring how LPs and GPs interact with one another. I mean, we're trying to break new ground in that area, and I think we certainly have created a different model than what's out there
because of the holding period, or
well, but the holding period as well as the fee structure, right? So I mean, us not taking fees of any kind and no reimbursements of any kind, it's highly entrepreneurial, right? So for our investors, they don't care if it takes us 10 years to deploy capital or 2 years to deploy capital, because like they're not paying for it. They don't care what our expenses are. They're not paying for it, right? So we're able to just do whatever we need to do without any sort of checkoffs and budgeting and all that stuff. So I mean, I think that the combination of those things hopefully creates a more sustainable, better model for how you partner with businesses. I think partnering is the operative word. It's not, you're not buying them and turning them into, sort of like a thing that just purely serves you that you can play with, and it's like a play toy, right? Again, these are all people, and we should treat them well.
Totally. And when is, if at any time, debt customer friendly?
Yeah, well, so I mean, I think you can use debt well if you see a clear path to expansion, to serving your customers better, where you believe that it's much more of a sure bet. You're not going to put the company in jeopardy by using it. And I know in venture it's the same way. There's venture debt for this exact reason. I think that's oftentimes not how, like, transaction debt is typically debt in the private equity business. I have no trouble with, in fact, in our businesses, like, we might close on a business with no debt and then say, you know what, we want to do this other acquisition. We think that actually using debt with our current capital structure and where we are makes sense to go and do that acquisition. Well, now we have stronger combined two companies, all that. Or maybe we have a huge customer who comes to us and is like, look, we want to double your revenue next year. You're going to have to gear up. Can you afford to do that? Yeah, we might take on debt to be able to gear up. So I mean, I think there again, like I said, anything else, there are good reasons to do things and bad reasons to do things. I think too often we get bogged down in just sort of one style of how to do things without sort of zooming out and looking at the larger picture.
Totally. So one thing I read about you is that you were born or sort of grew up an atheist and became a believer over time. Is that accurate?
Yep.
I'm curious, how did that process happen to you, and how do you, when other people, I'm sure a lot of other people come to you and are expressing similar sort of thoughts or longings or sharing, like, what is your sort of thoughts there? Because, while most of the world is religious in some form, not that many people in finance or technology are overtly so.
Yeah. Well, so, first of all, if somebody came to me and said, hey, I have these questions, I have these things, and people do approach me. The first thing I say is, I get it. Like, I had those same things. I mean, grew up going to church, decently regularly. And then just, I think I was, 8 or 9 years old. And, I can still remember I told my mom that, I was like, I don't believe that there's a God. And she was like, oh, interesting. And my brother starts crying in the back seat. This is actually a true story. And then so, I just had all these questions as I was a teenager. I felt like, part of this is youthful, overconfidence in your own, thoughts. And, I kind of assumed that, if I couldn't get the exact answer I wanted exactly when I wanted it from whoever I asked, then that means it must not be true. And so, became, what I would say is a pretty hardcore atheist, in my, teens and 20s. And then I started meeting people who were really thoughtful, scientists and, philosophers who were religious, who were believers. And I thought, well, that's really weird. Like, that's a cognitive dissonance for me. And I started reading about, kind of who they are and what they were doing. I would have conversations with them, and they would challenge me in ways that I just hadn't even thought about. And, here I thought that I was like the smug, superior, atheist, because I was like so smart in science and blah, blah. And then I started realizing that there's really no conflict between science and at least, I can only speak as a Christian, but, in Christianity. And then somebody, I think, started challenging me. I'm trying to remember who exactly in the beginning started challenging me and saying, do you believe what you actually say you believe, right? So if we're just a random co-location of atoms, we're sort of a wet sack of machinery that's, came from nothing is going to go to nothing, right? Like, do you actually live your life that way? So there's sort of like no inherent beauty, no inherent meaning. You can make your own meaning, but it's just made up, right? And I started challenging these things. These are very I still even get anxious today, like thinking about it. And I didn't really believe what I thought I believed, and I hadn't really taken it to the logical conclusion. And what I realized was the Western world is so steeped in Christian values. Where you look, and I know this sounds for a lot of people that aren't familiar with Christianity or have sort of seen the headlines and rejected the, Hollywood version of Christianity. Everywhere Christians gone, like, human rights have flourished. Right? At every stage of the way, even an eye for an eye. I remember I had this thing where I was like, well, an eye for an eye is so barbaric, right? Yeah. Well, an eye for an eye was a massive step up in justice. At the time, anybody could be killed for anything. If you were in the upper class, you could just walk down the street and murder people, and there was no recourse. There was nothing wrong with that, right? What an eye for an eye said was, no, every human is treated as the image of God, right? And you can't, the only thing you can do is retribution for that thing. Now, obviously, changed since then. Jesus came along and had some things to say about that. But every step of the way, it was an improvement on justice. Right. And so anyway, I just went through this incredible, sort of exploration where I studied the heck out of it. And I went through, and the biggest linchpin for me was, is Jesus real? Is he who he says he was? And I think there's a lot of evidence to suggest that he was. You got to do something with Jesus, is ultimately what I'd say. Either he was a madman or a liar, a lunatic, really, or he was who he says he was. And so you got to do something with him. He can't be like this just good moral teacher. Right. And so I think all those things came together, and ultimately, I became a believer, and it's been transformative in my own life. It's been a wonderful experience.
It's interesting. I had this Girardian scholar, David Gornosky, on the podcast, and he talked about sort of the irony of even the new atheist movement, who sort of, shun religion in some sense and yet preach, progress and equality and sort of liberalism, how much that is directly inspired by, or indirectly inspired by Christianity, even if they don't want to admit it.
Yeah, I think that the question is where do we get our moral beliefs? Where's this inherent secular humanism that all people are created equal and that everyone should have flourishing? There's nothing like nature. If we just want to say it as we're in a state of nature and it's sort of raw, it's survival of the fittest, right? So there's nothing altruistic about nature. Yeah. At all. Right. And in fact, if you argue, and this is sort of a Malthusian argument, and a lot of the eugenics movement came out of a lot of this line of thinking, is we should actually let the weak perish. That is the exact invert of what Christianity teaches, what Jesus taught, right? Which is you should raise up the lowly. You should serve others, right? And again, a lot of this stuff, in business, going back to what we just talked about, I remember the first time when I fully appreciated that the God of the universe was also the God of my work. Yeah. And that if I said I believed, I can't sort of be a believer outside the office. I got to be a believer in the office. And it fundamentally changes how you treat people and what you do. But separate from that, I just don't understand where you get the sort of objective measuring stick. Cause I have one atheist, friend, and this is highly offensive, and it's his words, not mine, but he's like, I have a preference against murder. There's nothing wrong with it inherently, right? I just have a preference against it. So that's why I don't do it, right? But if it floats your boat, then go out and do what you need to do, right? And I think there's a lot of these things we just don't think about that are highly rooted in Christian ethics and values. But it gets controversial when you say stuff like that. And, without a relationship, there's no way to have a good conversation. So I occasionally get tangled up in Twitter on this, and I try to be as winsome as I possibly can, but there's really good answers to really hard questions, but you got to put in the work and you got to have a relationship in order to have them.
Totally. And last question I'll ask, which is a hard question that a bunch of people will have about this is, or I'm sure ask you, is how do you reconcile science and religion?
There's no reconciliation needed at all. It's actually incredible. So literally Christians created the scientific method. Literally. So when I say that, so almost all of the big scientific breakthroughs, right, were done by Christians. Now, an easy argument to make is, well, they were done by white men in the West, and the West was, at that time highly Christian and sort of societal, cultural Christians, right? That's not who these people were, though. Their fundamental undergirding of their worldview inspired them to explore a creator God that was intentional in design, who wanted to reveal himself. That is the scientific method. How do you find out what God is, who God is, what he created? That was literally the underpinnings of why they went down that path. These are the same people that created hospitals and universities. Literally the top hospitals and universities, the systems as we know it, were created by these exact same things to help the poor, to help the oppressed, right? And we just take them for granted as the institutions. Harvard's handbook, literally Harvard's handbook, then the very first edition says the purpose of going to Harvard is to know Jesus Christ better. That's literally the purpose in Harvard's handbook. And so I would say is the apparent conflict between science. Science doesn't have anything to say about morality, about love, about beauty. It doesn't have anything to speak on those, right? Great book, When Breath Becomes Air. By the way, don't read it on a plane. I made this mistake and people thought I was having a nervous breakdown because I was uncontrollably sobbing. But he goes through this exact journey in it. He's I'm a hardcore scientist. I'm a doctor. I think he was a PhD, MD. And he went through this whole journey of he realized that there was this whole other world that science couldn't explain. And so there's no conflict between science and religion. The God of the universe is the God of science. And I don't see any conflict in any way.
Yeah. This has been a fascinating conversation. I want to make sure that you're on time for your event. My guest today has been Brent Beshore. Brent, thank you so much for coming on the podcast. For listeners who want to go deeper into your work and learn more about you, where on the internet might you point them?
So I have to go to Adventures. So Adventures with a dot before the ES. It'll take you there. We're not Spanish, contrary to what people say. It's a hack domain. We have a lot of things on there, and a lot of writings. But I would say I'm on Twitter at Brent Beshore. Feel free to contact me anytime. Would love to chat.
It's been a great episode.
Hey, thanks, Erik.
Thank you for coming.
Really appreciate it, man. Thank you.
If you're an early stage entrepreneur, we'd love to hear from you. Please hit us up at villageglobal.vc/network catalyst.